bookkeeping. We're going to be looking at transactions, analyzing them, and recording them under the accounting equation. So we're looking for assets, liabilities, and stockholders' equity entries. Now let's look. Now it's important to remember that when you're analyzing transactions, the first thing to do is really understand what's happening in the transaction. And you may, because they write these things in a certain way, you may have to revise them a little bit to something that you can relate to make it better understand it. So event number one, Rustic Campsites was formed on January 1st, year one, when it acquired $120,000 cash from issuing common stock. This is the way companies get started. They sell stock to investors, and they take the cash and they use the cash for the company. So what happened in this transaction? We got cash, we sold stock. So under the accounting equation, we're going to say there's an increase in the asset cash of $120,000, and there's an increase in stockholders' equity, common stock. Now we see the equal sign here for all of you algebra experts. I'm not one of them. Whatever we do, because it's a linear equation, the linear equation says whatever you do to one side of the equal sign, you must do to the other. Since we have, then our equation stays balanced. So that was event number one. Event number two says that we acquired an additional $400,000 of cash by borrowing from a creditor. So what does that mean? Acquired means I got, right? So I got another 400 grand by borrowing. So if I borrowed, that's something I owe. So that's going to come under liabilities. And we're going to give that account, the place where we're going to hold that number, a name called notes payable. A note is a loan. So notes payable. We now have a loan on the books for 400 grand. We also, because we took a loan, cash is also going up by that same $400,000. So the asset cash goes up, the liability notes payable goes up. Again, either side of the equal sign, we're adding 400 grand. Event number three, RCS paid $500,000 cash to purchase land. All right, so what happened here? They bought a piece of land. They paid $500,000. So if I paid $500,000, that means that the asset cash is going to go down $500,000. Out-of-pocket cash. But we bought land, and land is something that the company owns. So it's an asset. So the asset land goes up by $500,000. This is called an asset exchange. One asset goes down, the other asset goes up. Again, note the way I read this. I read through RCS paid $500,000 cash to purchase land, and then rewording it so that I really understand what's happening here. Event number four, RCS obtained $85,000 cash by leasing campsites to customers. Okay, well, they bought a piece of land. Now we know what they bought the land for. They created campsites, and they're leasing the campsites. Obtained, they were paid $85,000 cash by the customers for leasing the campsites. So cash increased or went up by $85,000. And we have this earning of revenue. That's what this transaction is. They earned revenue. Earning revenue. Revenue is what you get when you provide goods and services. That's what you recognize. It's not the money, it's what you earn. So I have earned the right to get $85,000 cash because I leased campsites. Whenever you have an increase in revenue, that's going to come under retained earnings. So retained earnings is going to go up by $85,000, and cash goes up by $85,000. Note over here on the end, account title, this $85,000 increase in retained earnings is due to revenue earning. Event number 5, RCS paid $50,000 cash for operating expenses such as salaries, rent, and interest. Well, we all know when you own a business, it costs money to make money. We incur expenses. That's what those are called. So we incurred $50,000 of expenses here. Since we paid for them, cash goes down $50,000. Now, expenses are going to go in the same place as revenue, to retained earnings, but expenses reduce retained earnings. Remember, revenue increased it, expenses reduce it. And again, we have the account title over here to tell us what that $50,000 is, why it reduced retained earnings. All right, this is an interesting concept. The land that RCS paid $500,000 to purchase had an appraised market value of $525,000 on December 31st. So the question here becomes, is our land worth $500,000 or $525,000? And if it's worth $525,000, do we change the value on the books? Well, there's an accounting concept here. This is part of something that we're going to be talking about a lot this semester, which is GAAP, Generally Accepted Accounting Principles, GAAP. They're set by the Financial Accounting Standards Board, which sets the rules for accounting. And the historical costs concept says that assets are reported on the books at the amount we paid for them, their historical cost. And that never changes. There's another concept in here that needs to be addressed, and that is that because there's an appraisal of the property for $525,000, does that mean it's worth $525,000? No, it doesn't. What it means is that compared to other properties on the market that are of similar type, the value for those properties is $525,000. Our land is only worth $525,000 when somebody's willing to write a check. When somebody's willing to give you a check for $525,000, then it's worth $525,000. So we're going to use the historical cost concept for our assets, meaning that they are recorded at what we paid for them, and that's not going to change. So here's a summary of the transactions that were in here. We didn't look at all of them. We looked at most of them. So again, here's our accounting equation. Assets, liabilities equals stockholders' equity. We have accounts. Accounts are used to separate transaction pieces. So for example, we have an account under assets. We have an asset cash and asset land. Together, they're worth $551,000. Under liabilities, there's our loan for $400,000 that we used to buy the land. Comes down here, $400,000. We sold $120,000 of common stock. And we have ending retained earnings. Retained earnings started at 0. We added 85 for the revenue. Subtract 50 for the expenses, that leaves 35. And then we gave a dividend. A dividend is a return to the stockholder saying, we did well, here's some of the profits. So we gave a $4,000 dividend away. So we have an ending retained earnings of $31,000. Now the question becomes, does our accounting equation still balance? Because remember, we're all about balance and accuracy. Well, we have $551,000 in assets we have 400, 520, 520, 551. So the accounting equation balances, and we're good to go. From this, we're now going to create our financial statements. And remember, financial statements are simply formal reports. They have specific formats. And you need to know what the formats are. So for income statements, we're going to put the name of the company. The report, in this case, it's an income statement. And income statements are for a period of time. In this case, this income statement is for the year ended December 31st, year one. So this is going to cover from January 1st to December 31st, year one. In that period, we had revenue of $85,000. We had expenses incurred of $50,000. So we were left with a net income of $35,000. That's all there is to an income statement, revenue minus expenses. Now, they mention the concept of matching here. The matching concept says that we need to recognize revenue when it's earned and expenses when they're incurred, because the goal for accounting is to be able to show on the financial statements as closely as possible the expenses that were incurred to create the revenue that was earned. That's the matching principle. Revenues are matched to expenses. Now, in this case, our revenues exceeded our expenses. If, on the other hand, the expenses exceed the revenues, instead of having net income, obviously we have net loss because we had more expenses than the revenue that was created. And that's not what we want to see as business owners. All right, second report is called the Statement of Changes in Stockholders' Equity. So remember, stockholders' equity is made up of common stock and retained earnings. So we're going to be looking at each piece separately. First off, again, name of the company, name of the report, and the statement of changes is also for a period of time. Again, the same period of time as the income statement, January through December. Now, the statement of changes has a common stock section on the top, and then a retained earnings section in the middle. At the bottom, we're going to add the two, and that will give us our total stockholders' equity. In this case, we sold $120,000 of common stock, so that was our ending balance. For retained earnings, we started with zero because it's the first year. We added $35,000 of net income from the income statement. That's why we do the income statement first. And then we're going to subtract the dividends that we paid out. We paid out $4,000. So we have ending retained earnings of $31,000. And remember, we talked about retained earnings in the last video, and I said retained earnings are profits that have not been distributed yet. So you can see we distributed 4,000 of the 35. So we add 120 to 31, and we get ending stockholders' equity of $151,000. The next statement is the balance sheet, and the balance sheet pretty much tells us what's the company worth. Well, let's see. The company's assets are $51,000 in cash, $500,000 in land, so their total assets are $551,000. We have then liabilities, notes payable $400. We have total stockholders' equity brought over from here on the statement of changes of $151. So our balance sheet balances. Pretty cool. This is what accountants love to see. Everything works out nice and simple. Finally is a report called the Statement of Cash Flows. Now, if we go back a second, when we looked at the income statement, the statement of changes, and the balance sheet, they're based on earnings and expenses, things that we earned and expenses we incurred, not necessarily cash. So the accounting profession decided, in its infinite wisdom, we need something that reports just on cash, and that's what the statement of cash flows does. Okay, statement of cash flows essentially says, where did we get cash? Where did we spend cash? And it has three sections: operating activities, investing activities, financing activities. So under operating activities, we have the cash receipts from the revenue. We have $50,000 of expenses that we paid. So we have net cash flow from operating activities, 35 grand, which actually, if you remember, matches the net income from the income statement. The reason for that is that all the transactions were in cash. So next we look at investing activities. We bought a piece of land. We paid $500,000. So we have an outflow for investing activities of $500,000. The last section is financing activities, and we all understand financing means borrowing, right? Well, we borrowed 400 grand. That's that loan that's sitting under liabilities. We also issued common stock. That's considered borrowing. That's another 120,000. And then we had cash out for dividends. So we're going to subtract that $4,000, leaving us financing activities of a positive cash inflow of $516,000. When we net these three numbers, we come up with a net increase in cash of 51 grand. It started at zero because new company. So our ending cash balance is $51,000. And if you remember, we're going to go back and take a look at the balance sheet. The balance sheet says cash, $51,000. So the balance sheet gives us the ending balances for these accounts. The statement of cash flow says, how'd you get there? So here are our four financial statements. This is the way they're formatted. Note that they're showing here that the $35,000 of net income comes down to the net income on the retained earnings section of the statement of stockholders' equity. That's why we do the income statement first. Now, this common stock of 120 grand, that's going to come down to the balance sheet under stockholders' equity, as will the $31,000 in retained earnings, giving us a total of $151,000. And on the statement of cash flows, what they're showing here is $51,000 on the balance sheet, $51,000 on the statement of cash flows. So that takes us through Chapter 1. If you have any questions, again, you've got my phone number. You can text me. You can call me. You can send me an email. I am available to you pretty much all the time. That'll be all for today. I'll talk to you next week.